me again, Jane, but now joining us are three experts from different respective asset classes. So we have Daryl from bonds, and Kevin representing equities, stocks, and also some other markets that we actually shared today, and Jinyan is our portfolio management team. So with that, let us start this session with a quick question. So we always ask ourselves, what is the goal or what's the purpose of investing? Essentially, we want our money to actually work harder for us. So it actually builds long-term wealth. But sometimes investing is a bit like dating, where it looks exciting at first, but ends up all we want is actually a reliable, a resilient, and a good investment that actually grows over time. So with that, we are fortunate enough to have three experts from three different asset classes to actually share with us their views and their strategy moving forward. Let's start with a quick poll that everyone can participate, where we have which asset class that actually which asset class will actually outperform in second half. If you could recall, in the first month of the year, we have a wealthy, and you did answer the exact same question. Let us see whether this actually changed over time. So while waiting for the responses, let's go through with our panelists. Are they happy with their investment? Are they happy with what their asset class is doing this year? Let's start with Daryl.
Hi, good afternoon, everyone. Thank you for joining us today. So I'm Daryl from the market making team, specialized in bond investment. So in terms of bond market, for the first half of 2025, it is as expected. We see that yields are coming down, bond prices are going up. I believe investors that have invested at the start of the year, you guys are very happy looking at your portfolio. It's generally going up across the US market, Malaysia market, Australian dollar market. Generally, it's positive, but of course, we have nothing to shout. It's the asset class itself is something that is very safe and secure for investors to protect their portfolio. But all in all, it's a positive sign for the bond investors.
Looks like we have some good news for bonds, especially this year is quite volatile. So let's hear from Kevin. How does he think about the first half? Is volatile mean something that we should avoid at all costs and shouldn't invest entirely?
Okay, since my colleague Daryl representing bond, he has mentioned that he's quite happy with his investment. As an equity guy, I would say that I'm much happier compared to them. Just look at the Nasdaq index, look at all these equities index, China, US, Japan, although Malaysia is somehow lackluster. But overall, we can see that by sacrificing out some of the volatility, you are exchanged in return. So when it comes to investment field, we are sort of exchanging your risk, and we are looking for reward. So that's the ultimate goal for investment. And as an equity guy, I think that gives you a pretty good landscape for you to achieve your goal. So yeah, overall, I'm quite positive on equity. I'm quite happy with my investment. And to the second question, volatility, I think that no doubt there's different volatility there. But as long as you manage to calculate your risk to reward, I think everything is under control.
Maybe just a quick one. What's your favorite market moving forward? what would likely be your where would you put your money the most moving forward? Just one quick question.
I would say it's semiconductor.
All right, I think that echoes. Perhaps I think that's Kevin's view. What about Jinyan's? What do you really agree with them? And do you really practice that in your portfolio? Yeah, I mean, for the first half of this year, it's definitely an eventful year and full of volatility. Like a lot of things have happened in just 6 months' time. You see, we have new U.S. president, we have the tariff war thing, and also the escalation within the Middle East. So talking back within our managed portfolio, because we are investing in global, so we actually are able to choose between how much we want to invest between equity and also fixed income. And because we are invest globally and unavoidably, we are also being impacted by all this volatility in the market. But the key thing is whether all these investments, or including the managed portfolio, are able to recover from the drawdown back in April. So if you look at our performance, I would say that currently, as of the latest data, is already back to the positive territory. No doubt, we also took a hit from the Liberation Day falloff, but after that, we do recover quite well. Take our aggressive portfolio as an example. From the bottom back in April low, we actually recovered close to 15%. So I think this is also another thing that investors should be looking at. Whether after your investment making losses, taking a hit from the market, are they able to recover when the market rebound? I think this is also the key thing that investors need to take note about. I think what portfolio really stands differently compared to the other two is that they do have a team behind where they actively manage and watch your holdings. So they could select the best in this investment universe to actually craft portfolios for different risk appetite. First, we take one question from the floor. Like we have one question up here is that why is China considered a dark horse? I think this one is rather interesting. Perhaps we can have Kevin to actually somehow express your view on this.
Okay, cool. China, if you still recall, if you are FSMONE follower since I think 2 or 3 years ago when China property have this kind of all these looming uncertainties. Back then, we are one of the contrarian party in the market, where everyone is still kind of bullish on China. We think that because of all these uncertainties, especially on the policy side, we are quite bearish on China. But moving onwards to today, we are seeing that there are a signal of recovery in terms of their confidence. Of course, their property definitely as some signs they are still, I think it still needs some time to recover. But again, when we look at the stock market, it's not just about property. When we look at stock market, how confident people to the market, it is a good thing for us. Let's say we look at some of the foreign investors, the foreign investment into the market, we are seeing that there are a sign of recovery. Let's say tariff. Back then, when Donald Trump announced the Liberation Day, the market is spooked by people are thinking that the geopolitical tension is going to persist. US and China is not going to be the good friend, but it has appeared to show that people are over worried about China. So now, when we look at the fundamental of China, we are seeing some of the signal of recovery, especially DeepSeek is a wake-up call for us. China, despite they are sort of like limited by US, but China has proven that they have the capability or the innovation and they have the ability to make their product better, even though lack of support from the global counterpart. So overall, when we look at the fundamental, China is recovering. When we look at the policy, China is also recovering. And last but not least, since I mentioned about policy, I think one special thing about China and the other parts of the world, at some point of time, they are quite relied on the money flow. Means that they need investors' confidence to boost the sentiment. Malaysia is one of it. You can see that followed by the foreign outflows and inflows, KLCR appear to be quite positive correlated. But when we look at China, it is a special market. It is a really top-down market, meaning that as well as the government, they are positive, they are injecting the stimulus into the market. It somehow provides confidence, no matter it's domestic or foreign, to the market. So overall, from the monetary side, we can see that CBOC, they are still bullish. They are still injecting money into the market. Fiscal side, the CCP is also injecting the stimulus into the market. So combining both, we think that China could continue to perform in the second half of this year.
I see. I think Kevin gives us a very comprehensive view on how we should look at China when it comes to a new landscape of investing, especially from a top-down perspective, and how do you assess the strength of policy terms in China. Perhaps the one thing that I find particularly interesting in this Q&A is that people are asking why Malaysian market is still weak. I think this refers to equities, but before we reach out to that, maybe we can have Daryl to somehow address if Malaysian government relatively is something that investors should actually pay attention to starting from now on.
Okay, I think before we talk about Malaysia's market, first off, we need to think about what happened recently, which is the OPR cut rate. So BNM has decided to cut at 25 basis points. So generally, when there's a rate cut, bond prices will go up, which is why, back to the previous question, we were reflecting on the first half of 2025, we say that if you're invested at the start of 2025, the portfolios have went up. So if you are talking why Malaysian market is still weak and whether MGS is a good investment, I say if you are looking to invest in MGS, you should be looking at a slightly longer tenor because for the second half of 2025, we will not expect a rate cut, probably in 2026. So if there are clients that are looking, investors that are looking to aim for the capital appreciation, you should be looking at the longer tenor. But of course, this is up to your risk appetite. For investors that are not too keen on the duration risk, you can look at some of the investment grade bonds. They are still giving around 4.5 to 5+% for a duration of 3 to 7 years. So basically it's belly of the curve. So if you ask me if Malaysian market is weak, I don't think so. We are still quite resilient. We are still growing, and monetary policy is trying to grow by injecting more money into the market as well. So for investors looking at Malaysian market, yes, you can consider investing in the bonds as well.
Okay, I see. So MGS really deserves a place in the portfolio if you have overlooked it in the past few years. So if they are cutting rate, your FD could be coming down as well. That's why it's being reflected in the FSMONE cash account. So, but assessing bonds is not easy. But we do have people from portfolio to help us do the favor. So we have just to link up with two questions from the Q&A. There are people asking will unit trust be replaced by ETF soon? While at the same time, is our managed portfolio only investing ETF in UTs itself? Perhaps we can Chin Yen to answer this.
Yeah, actually currently within our managed portfolio, we do have exposure to both unit trust and also the ETF for different products. So if you ask me, will unit trust be replaced by ETF completely? I don't think so, but of course we are seeing increasing trend where there are more and more ETF providers coming out with different coverage, different country, different sectors. So undoubtedly, ETF does have some competitive advantage, in terms of effectiveness, in terms of the cost. But we think that there are some areas that ETF still cannot replace unit trust. So for example, in some of the markets that is not as efficient, especially in Asia, that we do require effective fund manager to evaluate the market, to do the bottoms-up analysis, to do the stock picking. So this is where fund manager can really add value to their stock selection and also add alpha to the fund performance. So back to this question, we don't think that unit trust will be completely to be replaced by ETF, but there are really some of the areas that investors should pick more carefully, and there will be certain products that will likely to outperform compared to another in certain area. So another example could be if you're investing in more efficient market like the US, the tech, the semiconductor, then investing in ETF could make more sense because market moving very fast. And looking at the benchmark return, if you compare the benchmark return and the fund performance, it could be quite difficult for the tech fund manager to outperform the benchmark. If you look at S&P 500 annualized return, looking at history, it's giving you 12-13%. So this is something that fund manager could be difficult to deliver. But for some of the not as efficient market like Asia, unit trust does still provide value, and for them to do the stock picking and the bottom-up analysis. So within our portfolio, the positioning is also there. The ETF exposure are mainly within US, the tech, and also the semiconductor sector. So we will likely to maintain this kind of positioning moving forward and more nimble in terms of selecting the products to represent our allocation within the portfolio. Okay, I think Kevin has something to say.
Yeah, sure. Apart from market efficiency, actually in terms of unit trust, I know that for the recent years, a lot of people, they are bashing unit trust because it's relatively underperformed ETF in certain markets, especially those developed markets like what my colleague Chin has mentioned. So for unit trust, I think it's quite a good time to share with you what's my thoughts of unit trust. I believe that in the next couple of years, probably in the next decade, unit trust is going to transform. You can see that, let's say, some of the sexy products in the market, hedge fund. So can you get the exposure of hedge fund via ETF? For now, you got limited options. Now, do you know that on our platform, I think we have about 4 unit trusts that wrap a hedge fund. Yep, just for information, it's a wholesale fund that unit trust serve as a wrapper. It comprises some of the hedge fund features of the unit trust. So I think that they don't have an absolute answer where ETF is better or your personal needs. So overall, I think that unit trust, ETF, both deserve a place in your portfolio.
I think it's the right mix. It's about the right mix that we actually put into consideration when it comes to ETF and unit trust. Just now, Chin actually bring up one aspect of it is that about the return itself. The return profile for these two are actually quite different, as similar when it comes to risk. So what are the talking about this, right? When you find a ideal partner, you look for good qualities, and you're trying to influence him in a good way so that you guys have a good relationship. So when it comes to manage portfolio, what are the key changes that the team has actually did in the past?
I think perhaps I can share some of the changes that we have made in this year itself. So beginning of this year, we actually moved to increase the ringgit hedge exposure within the portfolio. So we know this year itself, ringgit has strengthened against US dollar quite a fair bit, like 6 to 7% on year-to-date basis. So in beginning of this year, our wholesale is more towards positive on ringgit and more neutral on dollar. That's why it translates into our strategy to increase our hedge exposure for the overall portfolio, especially on the equity part. And of course, it turned out that it has benefited us because ringgit has strengthened against US dollar quite a fair bit and also somehow enhanced overall portfolio performance. So other than that, in just May, like 2 months ago, we actually moved to reduce some of our exposure within US direct to increase our exposure into global tech and also like digital economic. So the thing is, back to 2 months ago, we are being more cautious on US equities because of the rising policy risk within US overall. So, but we are not turning bearish on US equities just to reaffirm. It's just that we want to be more selective when investing in US. So, for example, like semiconductor, digital economy, these are the themes that we still like. So if you look at the performances, the move also somehow benefited us because the tech sector has continued to perform. So when investing in US, we need to be more cautious and also be more selective in choosing those really quality companies, looking more back to the fundamental itself. And in the beginning of this year, we also moved to increase our China exposure. Like if you are following us closely, one of our key investment team for this year is China, really Chinese equities that could be the dark horse for this year. So it's also reflected in our portfolio allocation, but it's more towards a tactical positioning because we think that it still requires more time for recovery, but it's warrant a place for us to actually initiate a tactical position into the portfolio at this point in time. So these are some of the key things that we have made to the portfolio in this year itself.
I think somehow it quite echoes the way that we consider our recommended fund list. We have core and also tactical position. Also, you highlighted the risk in terms of your currency exposure, which you actively manage in the portfolio for investors. So perhaps talking about currency, I think this is the bread and butter and the most important thing when it comes to investing in bonds. Let's have Daryl to actually run us through what are some of the attractive bonds ideas you have, and also how do you assess the currency risk in bonds investing?
I think previously China has mentioned that China is a region that they are focusing on. But on the bonds perspective, I think there's two regions that we can take a look. So the AUD space as well as the USD space. Why do I say so? Because ringgit has strengthened a lot against Australian dollar through the start of the year. Back then it was at 3.1 area, now you're looking at 2.7 area. So what this means that it's cheaper for you to convert your ringgit to Australian dollar. And once you have converted to Australian dollar, you can invest in Australian dollar bonds at a cheaper rate. And the interest rate environment in Australia is higher than Malaysia, plus you can get a return of around 5 to 6% for a relatively safe investment grade bonds for such as the top 4 Australian dollar banks, the ANZ, the NAB, the CBAU. So these financial sectors, which are usually very resilient during the uncertain markets, these are the papers that you can look at. And historically, if you look back at Malaysia, we always, there are times that our FX outperforms other regions, but it doesn't stay for long. So why not at the current market where Malaysia is strong against Australian dollar, lock in your FX rate? If you believe it will go down even further, then you can, like we apply in stocks, dollar cost averaging. You can dollar cost average your FX exposure as well. So you can convert a little bit by a little bit and then invest in Australian dollar bonds. In terms of US, it's a bit more complicated because if my suggestion is not to look at the value of the curve, but 5 to 10 years, we should be applying a barbell strategy. So invest in the short term, less than 1 year, and on the long term, more than 10 years. Because if you look at the yield curve of the US yield curve, at the start, it's very steep, and throughout the valley, it gets lower, and after 10 years is where it goes back up. So for you to be safe, you have to be looking at the two ends. So when you're investing in the short term, you are locking in your capital, and you're investing in the long term, there are possible capital appreciation given that interest rate is about to come. So this way, you're protecting yourself overall.
I see. So the keynote here is that there are actually other currency bonds that you can consider other than Malaysia alone. If you currently have the existing assets in those currency, or you wish to actually capture some of the currency gain other than the bond capital appreciation itself. Maybe one question that I find a lot of people are actually quite interested in the Q&A is actually, will FSMONE recommend crypto-related portfolio? I believe UT selection methodology actually cemented on 3 big categories. So we have equity, fixed income, and balanced portfolios. I think for now, in the foreseeable future, perhaps crypto-related portfolio is not something we will consider. However, this is up to your personal risk appetite. If you're someone who okay with high risk and someone comes with speculative flows, perhaps this is something that you will consider in your portfolio as something that you add onto your alternative investment. But for FSMONE, perhaps in the short term, may not be considered. So for Kevin, I think you have noticed the green one question. Do you think there's a chance the stock market to crash again? Same like it was caused by tariff wars.
It's a tough question. Well, what I want to say is there a chance? Yes, it is. Is there a chance of heightened volatility? Absolutely. But what I'm telling you is today, I'm telling you that there is a chance of stock market to crash again. Definitely, I'm scamming you. Because no one got the ability to predict when, where, what is the reason of stock market to crash. Again, I want to bring you back to maybe just COVID. When COVID happened, a lot of people are saying that, oh, COVID is happening. You should buy at a dip because the price is cheap. After that, let's say you buy immediately at the second day of COVID, the price is continuing dropping. Then at that point of time, you're going to be kelang kabut. Let's say if you manage to capture the bottom of COVID is a V-shaped rebound, then you're going to earn quite lucrative profit. That's what's telling us from there. No one got the ability to time the market. And I'm telling you from the perspective of the professional investors, and I'm telling you as a perspective of retail investors like myself before I joined this industry. Well, back then, I would just like to share some of my personal experience. Back then, I described myself as a trader. I look at all these technical charts, those RFI, support line, Bollinger Band, so on and so forth. To be honest, have I gained some of profits? Yes, I am. Have I made losses? I do. But ultimately, when I look at the longer term, I review my portfolio. I feel like the time I've spent in terms of trading all these markets and the profits, the return I've gained is not that lucrative enough. Again, I want to emphasize risk to reward. So now, you know that we are busy with our personal life, we have our own commitment. So if your hobby, if the only thing that you are only care about is investment, then yes, you should go to investment. And you can go and try to analyze those market crashes. So I can almost guarantee to tell you that no one has the ability to manage to capture whether the peak or the bottom. So I'm telling you that if the market is crashed in the second half, no matter it's because of tariff, no matter it's because of any surprise for us, I'm telling you, invest based on the fundamental thesis. What is the fundamental thesis? Let me share with you. If you follow us, I am one of the analysts who covered semiconductor back then. And I still remember that when DeepSeek surprised the market, a lot of people they are concerned that, oh, DeepSeek is coming out. This is going to be a breakthrough that is going to be threatening all these big GPU players. Am I trying to capture the market bottom? No, I can't. I don't have the ability. ability to study what is DeepSeek, what is the potential breakthrough of DeepSeek, what is the implications of DeepSeek to all my portfolio. So after I studied all, back to the fundamental, I look at some of the stocks like NVIDIA, like AMD. You can just search my name. I did publish some of my articles back then, and ultimately, when the market rebound, we managed to capture the upside potential. Again, I just want to highlight, we have no chance to predict the market. Is there the volatility? Are we expecting any volatility in the second half? Yes, we do. But ultimately, back to the fundamental, stick with your fundamental thesis and keep invested.
I think Kevin did mention a lot about he did answer this $1 million question. So whether or not stock market crash, just be resilient in your portfolio and don't try to time the market. It's all about time in the market. So let's follow through with a spicy question to Chilian. So how did your portfolio been doing? We understand that last year ETF is giving out quite attractive dividend yield, close to 6%. So is it worth investing in portfolio with Chilian?
Yeah, I think this is a fair question, because these are all the investment options available to investor, and for sure they will need to compare and make the best decision for them. And I would say that for ETF, it's a very good investment strategy that for you to grow your wealth, for you to actually plan for your retirement. And there are a lot of investment strategy in the world, right? And portfolio management is also one of it. So this is definitely another thing that you can consider to incorporate into your own investment portfolio, as in, for example, some of the scenario when there is some pullback in the market and you wish to buy something at a lower price, but at the same time you want it to be more diversified in terms of the resiliency and also the risk management perspective, then portfolio management could be one of the options for you. So I would say that there are a lot of investment strategy in the world, but not every strategy is suitable for everyone. So at investor level, you still need to evaluate what is your financial objective that you want to achieve, like how much you want to put into this particular strategy, how much you want to put into another one. So whether it will fit your purpose and achieve your strategy within your desired investment horizon. So portfolio management is definitely something that is, the increasing trend in the world. People are looking at more diversified investment approach. The investment vehicle that are able to capture the market upside, but at the same time are able to offer some of the resiliency from the risk management perspective. So I would say that from this perspective, there are some differences between these two investment strategy, but portfolio management is definitely something that investors should consider also.
I think the emphasis here is on how it helps to move your investment journey, so that when it goes through the ups and downs in market cycles, if you just invest purely in equities or particularly in US itself, you could have experienced the fluctuations. Sometimes in bonds, you would also see that the painful lesson that we learn from currency risk itself. So first, just keep the question coming. So I believe you come here with a lot of questions in mind to ask the experts how to navigate second half. So keep the question coming. So let's get Daryl to tackle this. I think he actually touched a little bit on the long and short end. Perhaps you can highlight a little bit more specifically to US Treasury bonds, how to position.
Yeah, so for how do we navigate in investing in US Treasury bonds, as mentioned earlier, I think the barbell strategy works especially for retail investors. It should be very effective. Because what I've mentioned is that currently the value of the curve, you don't see much duration to reward. You need to say that the curve is not as steep at that area. So at the lesser than 1 year treasuries and more than 10 years is where you see the gains for additional duration that you are taking. So for those that are looking to trade, which of course by buying bonds we don't advocate trading, but that's something that investors could potentially explore, given that interest rate is likely to be cut soon in the US, right? So for those that are looking to trade, you can focus more on the long term, because that's where the capital appreciation is most sensitive to interest rate changes. Of course, some may argue that some are priced in, but in actual, when it really happens, usually there are movements in the US Treasuries. So for retail investors who want to be more balanced in their exposure, you can look at the short term as well as the long term. If I were to give a percentage weightage, I could say 60-40, 40 on the long term, 60 on the short term. So currently the short term US Treasury is still looking pretty attractive from 4+%. So for maybe if I can also talk about a little bit in MGS and Australian dollar space. So for Malaysia, long term, as usual as well, if you're looking to trade, look at the long term. For short terms, focus on investment grades, 3 to 5 years, 3 to 7 years, A-rated and above. These are some of the, for example, recently Exim on our Bond Express as well, we have onboarded Exim. So it's a 4-year bond with close to 4.7% return. So if you were to compare to your FD, right? So currently promo rate you're seeing at what, 3.6, 3. I don't know, depending on how much your bank is offering. But if you're looking to lock in 4+% for the next 4 years, in the expectation that next year there will be a rate cut, then this is actually a good deal, especially when you have certain issuers that have solid cash flows. Of course, do your due diligence. This is just something that I'm looking to summarize for everyone. But you can look for the Malaysian space, you can look at the corporate bonds at the value of the curve.
I see. So that's definitely a very clear idea on how to actually invest bonds, and you can do it globally as well, not just MGS. And he did illustrate a very good way to actually invest in it. So perhaps something has to do with Malaysia, I guess. So you can run away from acknowledging that Malaysia equities has not been doing that pretty well this year compared to the rest of the world. Just imagine our investors, they do have their portion of the investment in Malaysia currently. What should they do?
They should listen to my presentation for the next session. I'm presenting Malaysia, I think about 2:30 p.m. Yeah.
Okay, I think he did answer that. So just stay tuned and come back after lunch to again listen to what Kevin is going to guide you for the next half in Malaysia. So let's, for the next, we have 8 minutes left for this session. So for any questions that in your mind, please keep coming. So let's get to the strategy part. So we all love strategy, and we all want to know how to actually strategically invest for the next half. Perhaps we can get Chin Yan. So after talking about all the changes you have done in the first half, so moving forward, what is your plan? And also, are you investing particularly in any parts of the world that you mentioned earlier?
Yeah, I think our current portfolio positioning is quite well positioned to capture the market opportunity. So, for example, in terms of the inter-asset allocation, we are turning neutral towards both equity and also fixed income, like since middle of last year. Because, for the past 2 to 3 years, market had quite a good run. Global equity has been rallying quite a lot. So, last year, at that point in time, we think it makes sense for us to actually to be more, to increase our fixed income allocation. So not to say that we're becoming bearish on equities, but we are thinking both equity and fixed income giving us same quite similar attractiveness. That's why we move to neutralize our inter-asset allocation. So within our current portfolio positioning, we still having a key overweight position in area like Japan, semiconductors, and also the technology areas. So, for example, Japan is the place where we see the structural reform will continue, and they are really coming out from the lost decade that they have experienced for the past 20, 30 years because of the recovery after the COVID, and inflation has been picking up. So these are some of the factors or the reasons that we look at when we want to position into a particular market. So the technical part, I would say that the ringgit hedge exposure is considered quite a tactical move for us to do, like since beginning of this year. So of course, moving forward, we will continue to monitor the market development, whether there is a need for us to remove the hedging part. And another part would be on the product selection, because looking at our research, we say that we are positive on certain country or sectors, but if the underlying products, whether it's unit trust or ETF, if the fund manager is not doing a good work, then it will impact our portfolio performance as well. So the product selection is also another part. The fund selection is also another part that we constantly monitor, and to do the necessary switching when we see a particular fund has been underperformed benchmark, has been underperformed the peers, and we cannot get a satisfactory answer from the fund manager. So I would say that these are the key areas that we will continue to monitor moving forward, other than the asset allocation, also on the product selection itself.
I got a simple answer. Sell when you earn enough.
I think that really sums up. I think thanks Kevin for the summary. I think essentially portfolio delivers value in a way that they have access to information directly from the fund manager itself, where they have talks and also they can share information across. While at the same time, their due diligence is quite comprehensive, which will actually give you peace of mind when investing with portfolio. Well, for those who love DIY, who want to expand your exposure, you can consider what Kevin and also Daryl have been sharing. So for the last 5 minutes, let's run through with Kevin for some of the markets that you actually like, but they are giving mixed signals, just like in relationship. You're unsure whether you should go for it or you should actually not. What are the markets that are actually giving mixed signals, and are you still confident in it?
Semiconductor. Okay, I think I explain why.
Yeah, maybe a little bit.
Okay. Well, semiconductor is kind of interesting market. It's one of the best performing market. And I can remember, let's say SMH when it's trading somewhere around 200 plus, 190, people are saying that, oh, it's expensive. But now look at the price. What's the price? So now second half will it experience a pullback? It might. So it's somehow giving a mixed signal. But again, back to what I mentioned just now, stick with the fundamental. Look at the AI development. How far we are there. In fact, we are just at a very, very early stage of AI. Look at those cloud, look at mobile gadgets, look at internet, look at PCs. These involvement, they have changed the market. AI, has it changed the market? Yes, it is. Has it completely changed the market? No, it's not. So this is why that in the longer term, I think that it gives me a very positive signal. Short term, definitely volatility is there because everyone is rushing to the market. So somehow volatility is going to persist. No matter it's second half, no matter it's next year, no matter it's 2 years later. But in the longer term, as long as technological advancement is still there, I'm going to be continuing to positive in this market.
I think that's a very strong conviction. Chin, you have something to say?
Yeah, I think we've been talking a lot about focusing on the fundamental, and here is a tip for investors who really want to stick to fundamental even when the market volatility increase. Because I know we are all human, right? We are affected by the emotion. When the market moves, when the market drop a lot, we will also be impacted. So one of the key things is to invest according to your risk profile. So your risk profile shouldn't change according to the market condition. Let's say if the market is, market rally a lot, tech has rally a lot, but you shouldn't change your risk profile because of the market. But it should be based on your financial objective, the things that you want to achieve, to invest accordingly. So this is the things that investors would need to take note when they are investing in the choosing their investment vehicle and also how much volatility they can take.
I think Chin did the job for me already. So just basically review your risk profile. We have the tool in our website, or you can reach out to CIS to assess what is your current risk profile. It tends to change when it comes to age and also retirement requirements. So Daryl, I think you are looking at the question already. So gold and silver have room to rise. Perhaps you can address more on gold. Also, I think this has to do with how attractive is bond. When Kevin has been saying semiconductor is very promising in giving you very high earnings growth.
Okay, if gold and silver have room to rise, I think historically, if you look at it, yes, especially during volatile markets, you do see rare metals, gold, silver to rise. But your second question is regarding how bonds.
How attractive is bond?
Actually, I think bonds, in essence, you just need to think of three things, right? So it's about stability, it's about income, predictable cash flow, and lastly, it's about diversification. They'll put everything into one basket. And bonds tend to be boring. We have nothing to shout, but when you are avoiding bonds in your portfolio, you are welcoming risk. Ask yourself, if you have invested bonds for the past 3, 4, 5 years, you may not be, having a lot of losses, but you are generating stable income. And this stable income is something that a lot of investors, they can sleep at night. They don't have to worry how, whether Trump is going to make any big moves, big comments or big administration changes. You still get your consistent cash flow. If you're investing in investment grade government securities, you have nothing to be afraid for the past 3 to 4 years. So I mean, in essence, think of bonds, think of safety. Nothing to shout, but boring doesn't mean it's a bad thing. Boring means stability. So that's all.
Stability is the key takeaway for bonds. And also, I think few of our experts are actually defend very well for the asset class that they represent, and they do what they understand the most. But if you are given a chance, what kind of asset classes or what kind of investment ideas out there you would like to invest or you would love to have it in your portfolio?
Bond, let's say SGS grew 4%. S&P alone gave you about 50%.
I guess Kevin is still holding on to his core of semiconductor. But what about Julian?
Yeah, coming from portfolio perspective or personal level. So actually, okay, to be frank, if you're talking about personal level, maybe I will tend to be more diversified because I'm still young. I have quite a long investment horizon. So alternative investment is also some of the things that I will consider for diversification purposes and also to increase the overall portfolio completeness in terms of to capture different market opportunities because some of the alternative investment they are quite uncorrelated from the traditional asset class that we are seeing like equity, like fixed income. So these are some of the areas that I will consider at personal level. So for portfolio level, we are still only looking at both the equity and also fixed income to play around with both asset class. Depends on the market environment. We can be more defensive or be more aggressive. Depends on how we believe the market will perform for the coming months. Sounds like Julian is very balanced in both approaches. So she likes equities, but at the same time, you shouldn't live without bonds. But what about for bond guy? Do you really only invest in bonds itself?
Personal level, no, obviously. I'm also someone of a risk taker, but I think as a personal investment, you should, if you're looking at bonds and you have a higher risk appetite, you can look at some of the corporate bonds in the US, in the Australia dollar. You can go close to up to 8-9% if your risk is up there. But personally, I invest in ETFs and stocks as well. But if you're looking at bonds, really look at the corporate bonds around 8-9% return. You can get it there. If you're more speculative, you can go for those defaulted bonds. You can bank that there will be a chance where there will be a dark horse to come and save them, a white knight. So those you can get 2, 3 times, 4 times X return as well. But these are, this is not the core of bond investment. You should be sticking to the fundamentals of why you're investing in bonds. Is to give you a safety net. When things are happening negatively, you have something to fall back to, and you get a consistent cash flow.
I think Bond has explained well how is his investment strategy, even though he is speaking in a capacity from bond segment. So all in all, I think this session has been quite insightful. I would believe that moving into second half, it will be a rewarding year for all of us to invest globally and profitably. And with these 3 segments, I think this is the only love triangle that you need and you thank you for in your portfolio moving forward. With that, thank you to our panelists and thank you for coming.